So, you've got some extra cash and you're thinking, maybe I should invest? If you're new to this whole thing, it can feel, well, super overwhelming. But in this explainer, we're going to break it all down step by step and make it simple. I mean, seriously, does looking at stocks and ETFs and all those crazy market charts feel like you're trying to read a foreign language? Yeah, I get it. But don't you worry, I got you. We're going to make this incredibly easy to understand. So, first things first, why not just, stick that cash in a savings account and call it a day? Well, there's this one little word, inflation. That $1,000 you have today, it simply will not buy as much stuff in a few years. Just think about it. That caramel frappuccino that used to cost $5 is now pushing 8. That's inflation in your coffee cup, and it's slowly, quietly eating away at your savings. So to fight back against this, here's our game plan. It's just 5 easy steps. First, we'll dig into why your money is shrinking. Then we'll talk about what you should actually buy. It's simpler than you think. We'll do a quick pre-flight check. Then I'll walk you through your very first purchase. And we'll wrap up with maybe the most important strategy of all, the art of just waiting. Okay, let's dive into part 1. Your money is shrinking. Look, investing isn't just for Wall Street types in fancy suits. It is the single best way for you to make your money start working for you, so it actually grows instead of just sitting there losing its power. Now, growing your money isn't some kind of magic trick. It's just math, and it happens in 2 main ways. First, when you buy a stock, you literally own a tiny piece of a real company. So if that company, let's say it's NVIDIA, does really well and makes more profit, its value goes up. And hey, guess what? So does your investment. It's that simple. But the second way, this is where the real magic happens. It's called compound interest. Albert Einstein supposedly called it the 8th wonder of the world. Basically, it's when your money makes money, and then that money starts making its own money. The best way to think about it is like a tiny snowball rolling down a really big hill. It just gets bigger and bigger, and it picks up speed all on its own. And get this. Just look at how that snowball effect really takes off. If you invest $1,000 a month, your first 100 grand might take about 6 years to build up. But the next 100 grand? That takes less than 4 years. Then the next one takes less than 3. And the one after that? Less than 2. This is the incredible power of compounding, and it's the biggest reason why it's so important to start as early as you possibly can. Okay, moving on to section 2. So you're on board, you're ready to invest, but the big question is, what do you actually buy? A ton of beginners make this huge mistake of chasing hot stocks, thinking they can be the one to outsmart the market. Trust me, that is a really, really tough game to win. Just because a company was a superstar last year means absolutely nothing about next year. I mean, remember BlackBerry or Kodak? At their peak, their shares were worth a fortune, like $145 and $90. And then, poof, they basically cratered. If you had invested based on all that past hype, you would have lost a ton of money. So, what's the smarter move, especially for a beginner? It's captured perfectly in this awesome quote from Vanguard's founder, Jack Bogle. Don't look for the needle in the haystack. Just buy the entire haystack. And you can do exactly that with something called an index fund. I know, index fund sounds like some technical, boring jargon, but it's actually super simple. An index is just a list of companies. That's it. A famous one is the S&P 500, which is just a list of the 500 biggest companies in the US. A fund is just a big pot of money from a bunch of investors that's used to buy all the stocks on that list. And an ETF, which stands for Exchange Traded Fund, is just a type of index fund you can buy and sell super easily, just like any other stock. So when you buy just one share of an S&P 500 ETF, you're not just betting on one single company to succeed. You are instantly buying a little piece of Apple and Microsoft and NVIDIA and hundreds of other awesome companies all in one click. You've just bought the whole haystack. Bam! Instant diversification. Okay, so when you're picking your first ETF, it really just comes down to 3 simple things. First, make sure it tracks an index you like. The S&P 500 is a great place to start. Second, pick one that fits your budget. Some ETFs have a lower price per share, which makes them way easier to get into. And finally, and this one is really important, look for a low expense ratio. That's just the tiny fee you pay each year. You want that to be as low as possible, like under 0.1%. All right, on to section 3, the pre-flight check. Before we hit the launch button and put a single dollar into the market, there are 2 really important steps to make sure you are financially ready to fly. First thing, do you have any of that nasty high-interest debt, like on a credit card? If you do, paying that off is your number one priority. I mean, think about it. The stock market averages around a 10% return over the long run, which is fantastic. But your credit card, that's probably charging you, what, 25% interest? Paying that off is like getting a guaranteed 25% return on your money. It's a total no-brainer, the easiest financial win you will ever get. Second, you gotta build a safety net. That means an emergency fund with 3 to 6 months of your living expenses just sitting in a savings account. Life happens, right? Your car breaks down or some unexpected bill pops up. This fund means you can use that cash instead of being forced to sell your investments when the market is down, which is the worst time to sell. So once you've passed that pre-flight check, you are cleared for takeoff. Welcome to Section 4, making your very first stock purchase. Let's walk through the actual steps right now. It's honestly just 4 simple steps. It's almost ridiculously easy. 1. Open an account at a big brokerage firm like Fidelity, Schwab, or Vanguard. 2. Link up your bank account and transfer some money in. 3. Search for the ticker symbol of the ETF you picked out. And 4. Type in how many shares you want, click buy, and confirm. That is literally it. You're done. And just like that. Seriously, congratulations. You are now officially an investor. You own a small piece of the biggest and most successful companies in the world. Just take a second and let that sink in. It's a pretty cool feeling. Okay, time for our final and, I would argue, most important section, the art of waiting. You've bought your first investment. So what do you do now? The answer is the hardest part for almost everyone. You do nothing. This slide right here shows you exactly why patience is everything. Imagine for a second you had the absolute worst timing in history and you invested at the very peak in 2007, right before the huge financial crisis. You'd watch your investment get cut in half. The normal human reaction is to panic and sell everything, but if you had just held on, by 2013 you'd have been right back where you started. And if you kept holding on until today, your investment would have more than tripled. That's the reward for staying the course. This is so important, so let me say it again. When the market goes down, you haven't actually lost any money. All that's happened is the price has changed. You still own the exact same number of shares. You only lock in that loss if you panic and you actually sell them for less than what you paid for them. And if you're thinking, oh, I'll just be clever and jump in and out to avoid the bad days, think again. Study after study has shown that if you miss just the 10 best days in the market over a long period, your total returns can be cut by more than half. And the crazy part is, those big upswings almost always happen right after the scary downturns, when you least expect it. So in the end, successful investing isn't about being a genius or picking the one perfect stock. It's about discipline, it's about patience. The stock market is one of the greatest wealth-building machines ever created, and history has shown time and time again that it always goes up over the long term. It rewards the people who are willing to play the long game. The only real question left is, are you?